Should I buy or sell shares today? Time to see the financial news.
Dow Jones hit a record high yesterday. Analysts are predicting it will go higher.
Okay, that's good news, right? Let's buy.
JP Morgan are predicting that market has peaked and advising all their clients to sell.
Oh, okay, that's bad news. Time to sell.
PMI data just came in and predicts business confidence in the months ahead.
Okay, that sounds like good news. I will buy.
The unstable situation in Middle East will have ripple effects throughout global financial markets.
Oh, that doesn't sound good at all. Time to sell.
Goldman Sachs says it's just the beginning of a long market valuations are as high as they ever been. It's unlikely for stock prices to go any further. Beginning of a
Dow
long
Jones
bull
hit a
run.
record high
JP
yesterday.
market valuations
Analysts are predicting
predicting
it
the
will go
highest
higher.
they've ever been. It's unlikely for stock prices to go any further.
Unstable
Is this you? You try to get some insight from the financial news that are presented to you, only to have them telling you conflicting information. Do you think it's helpful for you? Myth number 1. You need to keep up with financial news. These days, news travel at breakneck speed, and if you travel at the same speed, you will also break your neck. We all know that news has an impact on stock prices. When good news is released, the stock price rises. When there's bad news, the stock price drops. It appears that if you were to follow the news, you are able to invest according to the price movement caused by the news. When you get good news, you buy. When there's bad news, you sell, right? Not quite. Most of the time, by the time the news reaches an investor, the stock price has already moved. Even if you were to sit next to your computer the whole time with your finger on the sell button, by the time you catch the news on Bloomberg, it's already too late. Prices would have already dropped. So you see, monitoring the news can be very distracting and confusing for investors. Bloomberg and CNBC are often bragging about how quick their information is and how valuable they are to investors. For an investor, the information they offer often adds no value. It's not like they can privately release the news ahead of time and give you time to respond, right? The only way you can get news ahead of everyone else is that if you are working within the company, and even if you are usually bound by non-disclosure agreements and insider trading restrictions. Bottom line is that my advice for investors is to totally disregard news once you are vested, because by the time it reaches you, the prices have already moved and it's already too late. Even if you have your finger on the trigger, others will be faster than you. There's nothing you can do about it. So if a factory explodes in one of the company you own, do not panic because there's nothing you can do. Instead, before you invest, make a plan on what to do according to your risk management rules. And when bad news strikes, you stick to the plan. Myth number 2. Past performance guarantees future returns. In life, there are only two things that are definitely guaranteed. Number 1, death. We will all grow old and we are guaranteed to die one day. Number 2, taxes. As long as we live in this country, we definitely have to pay taxes to IRS. So in life, death and taxes are definitely guaranteed. And when it comes to investing, there is no guarantee. Anyone who promises anything guaranteed in investing is usually running a scam. If you look around the internet asking for expected stock market investment return, you will see the headline number of 10%. Yes, this is the past performance of the American stock market returns. It certainly is credible considering it has almost 100 years of track record. But beyond the headline average number, we also have to look at the standard deviation. The standard deviation is a measure of how spread out the numbers are. The smaller the spread, the better, the more certainty we have. If the standard deviation is 0, that means based on historical returns, we indeed get a 10% return per year. The average standard deviation of stock return over the full 90-year history is not 0, it's 18.85%. This means 68% of the time, the headline 10% number can jump between negative 8.85% to positive 28.85%, and then it gets even more uncertain as we increase our scope to 2 or 3 standard deviation. Having said that, while it's true that past performance does not guarantee future returns, with almost 100 years of track record, it's definitely the most indicative of the future. And this leads us to the next myth. Myth number 3. Investing is gambling. Because there are no guarantees in investing, some people compare it to gambling. With gambling, you are taking an uncalculated risk when you pull the lever on the slot machine. In the casino, the game with the best player advantage is blackjack. If a player follows the perfect betting strategy, the house advantage is only 0.5%. Craps offer the next lowest advantage at 0.8%, followed by baccarat with a 1.06% house advantage. You see, even if you do everything perfectly, follow a perfect betting strategy at blackjack, you are still on the losing end. You still get a 0.5% disadvantage. When you play not knowing your risks, that is gambling. When you play fully aware that you are sure to lose, that is not only gambling, it is stupidity or paying for entertainment. In investing, you already know that the historical return is 10%. Some years you can make minus 20%, some years you can get positive 30%. Overall, if you stay vested and over long periods of time, the odds are actually in your favor. Myth number 4. You must sell at the market peak and buy at the market bottom to be profitable. Take a look at this stock. Is it the top? It looks topish. How about now? Is it the top? Again, it looks topish. Let's zoom out. How about now? It still moves higher. You see, it's really difficult to pick up the top and bottom of stock prices. No matter how much you try or think you know, the stock market may continue to make new highs or new lows. The stock market is always difficult to predict, and those who try to pick tops and bottoms are usually disappointed. But the good news is that you don't have to identify tops and bottoms in order to profit in the stock market. You still can win, even if you don't perfectly time your trades. According to research by Schwab's, yes, indeed, if you are able to time the market perfectly, you will make the most money. And if you can't, it's still okay. You'll still make a lot of money. Even if you have bad timing and buy at the market peak, your profit can still be quite healthy over many years. Myth number 5. There's always an economic reason for stock market moves. There's a funny thing about a certain news channel that I watch. Every day, they report the market movement. When the market is down, they will say that it's due to profit taking. When the market is up, they will say that it's due to bargain hunting. And they will always use just these two generic reasons to explain away why the market moved for that day. I think what they are trying to tell us is that they have absolutely no idea why the market moves. Humans are hardwired to seek explanation for events. People will always ask why. Just like Enron's commercial. In the stock market, it's no different. Last year, listed technology firms had a good year, with the Nasdaq nearly tripling from March 2020 low. However, the Nasdaq and tech stocks are currently in a short-term downtrend. According to market observers, the rise in bond rates and worries of inflation have dampened demand for high-value tech stocks. Is this, however, really true? Perhaps, perhaps not. What's true is that most of the time, no one knows for sure what's causing the market to rise or fall. Because in truth, most short-term stock market swings are caused by irrational fear and greed. So the takeaway here is this: do not try to find reasons why the market moved. So what if you know? Drawing reference back to the first myth, even if you know, by the time the news reaches you, the price has already moved. It's already too late to do anything. What's past is past. There is no point dwelling on it. Instead, make a plan on what to do when a certain event happens and stick to it. For example, perhaps if the Dow drops 20% from its peak, you'll deploy 20% of your capital. Do you agree or disagree with this video? Subscribe, leave a like, and comment down below, and I'll see you in the next video.